Hi, everyone. This is Nick Gerli from Reventure Consulting. On this episode of the Note Closer Show, we're going to talk about the best markets and best neighborhoods to invest in throughout the United States and how you can use data to better inform your real estate investment decision.
This is the Note Closer Show, where you get the latest developments in distressed note investing and learn the secrets of how you can control millions of dollars worth of property for pennies on the dollar. Get educated and entertained by someone who has closed thousands of deals and lives to support you in achieving the same. Now, here's your host, CEO of We Close Notes, Scott Carson.
Good morning, good afternoon, good evening, everybody. Welcome to this episode of the Note Closer Show. As always, Scott Carson, excited to be here with you today. I'm really excited to have a fellow Austinite on the podcast. It's not very often I get somebody from here in the Lone Star State of keeping it weird in real estate, I guess you could say, here in Austin, but honored to have a new kind of Austinite join us on here. He is doing some amazing things and provides such great content and knowledge to so many people out there, investors, funds, and stuff like that. And so I'm really honored to have Nicholas Gerli join us. He's the CEO and founder of Reventure Consulting. He provides real estate investors and owners with recommendations on the best markets, which is what we're all looking for, and even neighborhoods to look for real estate growth. His company, Reventure Consulting, uses a proprietary database of economic, demographic, and real estate-driven indicators to analyze and rank the best places to invest. That might be a little important for you guys as we roll into 2021. So prior to doing that, he was in the, basically worked for a nationwide commercial lender, did over 200 large loans and equity investments, totaling over $2 billion in funding. So he knows the lending industry. And I came across him on LinkedIn, and as he was sharing some information about the best 10 cities out there in Austin, and I was like, I like what you're doing, Nick. So we got to get you on. So good morning, Nick. Welcome to the Note Closer Show. How's it going today for you?
I'm doing great today, Scott. I'm really excited to be on here. I'm really excited to finally be in Austin. Moving here was kind of a goal of mine for a couple of years. I'm originally from the Northeast, but I've slowly made my way south, and really enjoying the city so far. So I'm glad to be in Texas and here in Austin.
Yeah, I imagine, especially this time of year, without the snow and the cold of the the north. You know, I was born in Minnesota. All my family was in it, but I grew up in South Texas. But we would always like to show pictures of like Christmas and the holidays of us wearing shorts outside. You know what I mean?
Right. My family in New York is perpetually jealous of me right now.
Well, we'll have to get to where's your favorite place for brisket and breakfast tacos here before too long for you here.
That's right.
But let's talk a little about there. You've done such a great job with your marketing and really helping out. What made you get into what you're doing now with Reventure?
Yeah, so fundamentally with Reventure, my goal and passion is to inform real estate investors on the best markets and the best neighborhoods to invest their money in real estate. And I started thinking about founding Reventure probably around 4 or 5 years ago when I was working at a debt fund out of Boston that you talked about. And I would travel around the US and, close $20 to $50 million commercial real estate deals in all these different markets. Go to Texas, go to California, would go to Georgia, would go to New York. And I started thinking, I'm like, wow, on all of these deals, I feel like I'm being told the same exact thing. On every single deal, it was like, oh, this is the number one area for millennials. This is where all the tech is going. This is the number one growth city. And I was like, that can't be true about everywhere, right? Like some of these cities and some of these neighborhoods need to be better than others. Mm-hmm. And so that question really started percolating in my brain. And I felt like I didn't have the tools and the data to really answer those questions well, and to try to figure out, like, why is this city growing more than this city? And why is this neighborhood growing more than that neighborhood? And what does that mean for future real estate growth, value growth, rent growth? So it was about 18 months ago that I left my old company and really just devoted myself to understanding that question, becoming obsessed with it. And, I have an economics background by trade, so I apply a lot of what I learned in economics. And put these databases together that turned out to be really instructive and predictive of real estate growth when you analyze this data. So that's my goal, is to go to real estate investors and developers and owners and show them, hey, this is where the data is pointing you to in terms of where you need to invest.
Now that makes a lot of sense. That everybody thinks their city is the number one, and I guess it is number one for a lot of things. I mean,
Right.
It depends on how you spin the smoke or how much smoke you blow in a lot of cases. I mean,
that's right.
And what has been some of the underlying factors though that you look at? Because I know that especially the commercial side, especially depending on the commercial project, it all varies.
Yeah.
On what's going on with that property and the asset class, right?
Sure, of course. And yeah, you can never, you the uniqueness and individuality outside of out of real estate, right? Every deal is unique, but there's some common threads, right? And whether you're dealing with a multifamily property or even like a retail property, or I would even say office in a lot of cases, what you're really caring about and what you're really looking for are three fundamental things each time. I want to be in a city that's growing population, or I want to be in a neighborhood that's growing population. If you're growing population, that's more demand for apartments. That's more people who are going to buy goods from retail stores, and that's more people who are going to fill office buildings. The other thing you want is income growth, right? And that's, I find most people, when I say population growth, they get it, but income growth is just, if not more important. You need the population that's already there to be earning more money. Because if they're earning more money, well, that's more money to spend on rent. That's more money to spend on retail goods. And if they're earning more money, that's likely a sign that the economy is producing productive jobs, which will help the office market. So it's population growth, income growth, and the final thing you want to really look at is supply. And that's the thing maybe a lot of people kind of want to just forget, right? Let's just focus on the demand side of the equation, how many people are moving there, how much money they're making, but supply is really important too. So in terms of multifamily or single family, how many new permits are there each year, relative to the existing population? Do we feel like maybe there's a shortfall in supply compared to demand? Or do we feel like there's too much supply compared to demand? So those are really the fundamental tenets of where I start when advising clients on where to look.
That makes a lot of sense to supply, because I think a lot of people fall in love with a project versus looking at some of the economic factors. I know, like self-storage, we get self-storage deals that are sent to us, and that's one of the first things we look at. Okay, what's the 5 mile and 10 mile radius, and what's their vacancy factor to see if there is an opportunity to increase, to decrease vacancy in our factor. But if everybody's at 65, you're not going to go above 65 unless you cut your throat dropping rents. And you don't want to do that. That sets a bad precedent. So that's important to think about. And especially in cities that are growing, the demand's growing, there's lack of inventory, especially like here in Austin and some other parts of the country, the cost goes up because the demand is up and the supply is down. Now, I want to throw something back at you though. We're talking about office space. You think about what's happened this year in office space being hit so hard in a lot of places out there.
Sure.
How is that figured into kind of what your numbers are saying and things that you're looking at?
Yeah, and you're right. That's a curveball right there with COVID and kind of working from home. I think obviously people in the office space need to tread carefully, right? And they need to probably focus even more so on the underlying demand factors. So one thing I think is that, like that traditional downtown office skyscraper mentality, and that being the locus of where everyone wants to be, I think that's not so much anymore. And to be honest, I think that was even declining prior to COVID when you look at the data. So more of a what they call a polycentric office model, where there'll be different hubs and spokes kind of throughout a city of where the office clusters will be. The Domain in Austin is a great example. That's a development about 10 miles north of the city, where there's a lot of over the last 10 years where there's a lot of new office going in there. So I would say, in terms of practical advice for people looking at office, you want to look at where are small businesses concentrated in your city. is if you can find pockets where there's concentrations of small businesses, but maybe not as much newer office development, that could be a sign that there's some potentially untapped demand.
That makes a lot of sense because people are avoiding the downtown centers a lot of times with what's going on there, but there's still businesses running. You know, they talk about Austin being such a big city, and the expectation is that in 20 years, the center of Austin is going to be 20 miles west. You know what I mean?
Right.
Because that's where the city's kind of growing to, and knowing the path of progress is also something really important too, right?
That's right. So you can, one of my favorite ways to do that. So when a client comes to me and wants investment strategy advice, there's two ways to do it. One is starting at the city and the market level, trying to figure out what cities and markets do I want to be in, which is very important. But a lot of people already kind of know where they want to be, or they're already kind of committed to a location, or they live in an area and can't. It doesn't make sense for them to go to another market, right?
Right.
For those people, it's really important to understand, like the back of your hand, where the growth is in your city, where the income is, where the millennials are, where the spillover occurs. And one of my favorite ways to do that is just, you can load data, right? The census produces data on population growth.
Mm-hmm.
We can load that into mapping software in a program I use called Tableau. And we can look with heat maps, what are actually the highest growing zip codes fundamentally over the last 10 years in terms of population, in terms of income. And that's going to point you to what I like what you said, path of progress. That's going to point you to where the path of progress is heading. So yeah, that's one approach that I enjoy a lot.
I love that because usually what will happen is you have a lot of homes that get built in, and then the infill of commercial and things filling around that growth on the outside. We've seen that on the north side of Austin, where Cedar Park and Leander and other parts that 30 minutes out, to an hour outside of the city is really starting to grow because people don't mind waiting an hour in traffic to live in something that's 3-bedroom 2-bath versus 1-1. It's 3 times the amount of cost there for you. Now, with everything that's been happening in this last 12 months, looking at the market, what's your take? And this is a 2-part question. Where do you think the biggest opportunities lie for, let's talk the residential space and then the commercial investing space? And commercial may be a little bit of a mixed view, obviously.
Yeah. In terms of residential, I think there's two things that I'm looking at. One is, what are the undervalued and underappreciated markets? Right. So Austin is a great market, right? But Austin is not underappreciated or undervalued. Austin is fairly valued, I think.
Way overvalued in some cases, I say.
Yeah, way overvalued. Other growth markets like Raleigh and Salt Lake City and Denver, those markets are all great, have amazing demand fundamentals, but they're very discovered and explored, which means they have a lot of supply, and it means price points are a little higher. In uncertain economic times, maybe right now is not the best time to get in those markets. But if you can find a market like, let's say Columbus, Ohio, or Indianapolis, or Phoenix, where they're adding all these households and they're adding all this income, but they're not really adding too much supply, I think you put yourself in a pretty good position for investing in residential heading into 2021. Mm-hmm. That would be the first thing, kind of on a market by market basis. The second thing would be, if no matter what market you're in, is to look for where the spillover opportunities are. And so what I call spillover is, you look at your zip code, and you're not as much focused on the fundamentals of your zip code. You're more focused on the fundamentals of the surrounding zip codes, because that is proven to be very predictive of value and rent growth. If your surrounding zip codes and areas are really strong and stronger than your zip code's going to benefit eventually. So I would say, heading into 2021, focus on markets that have good growth but are underappreciated, and focus on neighborhoods that have spillover opportunities where population and income is going to spill over, and that's going to be positive for rent and value growth.
It makes a lot of sense to take it. That really makes a lot of sense, because that's where if it's saturated, it's going to leak out, and that's where it's. I guess you could call it the ripple effect for the most
Ripple,
part.
I like that. The ripple
You can
effect.
use it. You can use
Okay,
it.
okay, I will.
But that's But that makes a lot of sense everywhere. I mean, that's why the secondary markets do really well too outside of your major cities, because that's where people will go and roll into, and businesses will go to in the path of progress, I guess you could say. Now let's talk a little bit about where do you think the commercial market is, especially in 2020, because I think that's probably a whole different ball game in a lot of cases.
It is a whole different ball game, right? With the commercial market, particularly office, you really, the fundamentals are similar, but they detach a little bit, because when a company is making a relocation decision, they're, maybe they're not necessarily relocating to that secondary, what I call tertiary market. Like maybe they're not relocating to Indianapolis, but they're probably going to consider Austin, right? For instance, Palantir is this big tech company that just had an IPO, and they just moved their headquarters when they had the IPO from Silicon Valley to Denver. And then you're seeing, for instance, in Austin, Tesla's opening up their Gigafactory. So there's a big move right now in corporate relocations and expansions into these kind of what I call first-tier growth markets: Denver, Austin, Raleigh, places like that. So I think the office market will be strongest in those cities, which might be, those cities might be slightly oversaturated on residential, but I think the office demand and the retail demand in those cities will be really strong.
Yeah, I think you hit the nail right in the head there. I mean, Raleigh's and North Carolina's been a popular market for years, and things have been growing there. And Raleigh definitely has been going through tremendous growth out in that neck of the woods. We've seen that quite a bit with values in the residential, and then even the commercial stuff starting to really see, the supply and the demand be met, and growth, take place as businesses are moving there. And companies and investors are doing there. And like you said, people move there, they buy stuff, they need retail, they need office space, and all that stuff that goes to support them along the way.
Sorry, Scott, I just want to ask you, I know you have kind of a presence in different parts of the country. What markets do you, have you had success in, or what markets do you kind of prioritize and like?
So it's funny. It's not a surprise. I do love Ohio. I think Ohio is a great market. I think Columbus is the number one area there, not just because of growth, but it's one of the few cities that is seeing growth in Ohio, whereas a lot of the other cities are losing population. People are moving to the warmer parts of the country. But Columbus, with the Ohio State there and other things going on there, is doing really well. Indianapolis, I'm a big fan of that. Indy as well, because it has some growth. It does have some very affordable real estate still, and when you look at what rent rates are compared to property values, it's got a nice ratio where rent rates are pretty higher compared to other places of the country. I still am a fan of Michigan. I think the major cities in Michigan are great plays. I would avoid, some people give me crap about Flint, but I'm not drinking the water, and there's still people living in Flint that are loving it there. And you can still pick up in Michigan relatively inexpensive real estate with a nice rent rate, or even if with us buying the debt, the debt ratios and the mortgage payments that we modify work really well for us. So those are things I do think that parts of South Carolina, other areas of North Carolina are going to do well. Florida's, I think, has been overpriced, especially in the southern tip. If you look back what happened 12 years ago, Florida's pretty much recovered. But I think what's going to be a big opportunity is I hate to say this, but it's the void of jobs in Orlando, with it being such a big tourist and hospitality and event space. It's going to be really cheap to have an event in Orlando, and it'll be interesting to see what happens with the Biden administration. If they do shut things down, it's going to get even worse.
Yeah.
But I think, looking at, I'm a big fan of Hollywood, Florida. I like the southwest part of Florida as well. I think because you get a lot of people from New York moving down there that have kind of, we're going to kind of chill. So I think, while that southwest Florida part, like Lehigh Acres, Cape Coral, I don't talk about Naples. Naples, I just think, is overpriced, but it's still a beautiful, beautiful spot to be at. I think those other areas, what used to be big touristy spots, you're going to be able to find some deals there as people are moving away from that, and other opportunities in either short sales or foreclosures or note sales, because we're starting to see some of that stuff pop up right now with what we're doing.
Yeah, that's interesting. I like a lot of the markets you mentioned, and it's interesting. I think that you touched on 2 points that I think are interesting. One is that inbound migration that a lot of Sun Belt cities are getting, and Florida is getting in particular. Florida is great for real estate because they're getting all this inbound migration, but they don't expand supply as much as, say, some of the other growth cities we've talked about in the Southwest. And so I think Florida has really good demand supply dynamics.
Mm-hmm.
And the Midwest cities are also interesting. Like you said, a lot of those Midwest cities, whether they be Pittsburgh or Cleveland or Akron or Detroit, are really flat or even negative on population growth, which is concerning. But then you look, and probably because of that, there's literally like no new development in those markets.
Mm-hmm.
And there's still people there who are staying there and want to live there and want quality housing. So I actually think some of those Midwest markets over the last year have been the best performing in terms of value and rent growth.
Yeah, I totally agree to that. I think I'm not a fan of Cleveland because of some of the things that Cleveland has done, the city has done. If you take back a property of foreclosure, you've got to bring it completely up to brand new code with double pane windows and other things like that.
Oh, I see.
And they require investors to basically purchase a bond, a $10,000 bond, which is not fully refundable. So it makes it kind of hard if you're an investor that goes wanting to go into Cleveland when you go to Akron or Canton or Dayton or Columbus or even Cincinnati in Ohio for some better deals for the most part. So without having to jump through those hoops. And you see that in different parts of the country, cities trying to enact things. I mean, Chicago's been dealing with this for years of all the zombie houses, the zombie homes out there, the vacant homes that are just, big X's on it. If they catch on fire, don't bother trying to save them because we've got too much of a glutton of inventory out there. And
is that when you say zombie homes, so no one's living there, but then the city, I heard like in Detroit, the city raises homes like that. But do they not do that in Chicago?
They will do it in some point. Yeah, they will do that and knock it down, or they just don't have the resources in a lot of cases. We've also seen, like you said, Detroit does that. Cleveland does that. Chicago does it. It's gotten better as the South Side's regentrified a little bit, but you still have a big problem with violence and vandalism in the South Side parts of Chirac, as I like to say. And
yes.
and the foreclosure process in Chicago compared to the rest of the state of Illinois is difficult.
Yeah,
it takes forever to foreclose. Very corrupt legal system. If you don't live there, they don't usually side with you. So they'll side with a tenant, they'll side with a borrower who lives there because their votes versus your vote. And we've seen that. I hate to say that, but that's what we see happening. They'll give their borrowers time and opportunity again. I'm like, come on, man, I'm trying to bring the property back up to help the neighborhood. You don't really want to help me. So
yeah, it's like anti-growth initiatives.
It feels that way. Yeah.
Yeah, that reminds me of a story I heard about Chicago a couple years ago where the tax assessor would always assess the values high on all the properties, whether it be homes or apartments. And it was just kind of known that he would assess it high, and then you would hire a lawyer to appeal, and then they would knock the assessment down to quote unquote fair value. But it turned out that everyone went to the same lawyer to appeal it because he was like the best lawyer to appeal it. Well, it turned out that lawyer was the one who basically funded the tax assessor's campaign and got him elected. So it was this kind of really backhanded, dirty kind of trick where it's like, all right, we're going to assess high just so we can have this lawyer kind of make some money on the appeals. And the unfortunate thing about that is, who does that end up really hurting? It's often maybe like poor, more disadvantaged people who don't know that they can appeal and don't know that they can, hire a lawyer to repeal their tax assessment. So that just reminded me of that story for Chicago.
Yeah, I mean, Chicago was like that. Then a few years ago, you had something similar happen in Detroit, where they had tax sales, and they sold every property that was going to tax sale to one guy who owned a big car dealership, and they sold the tax sale stuff to him well below value. I mean, well below what they would have gotten in an original auctions aspect of it. And there's a big uproar about this. This guy was a big car dealer, had a big car dealership, and for like $4 million, he bought every tax sale in a swoop like that, and it was just a big uproar. And it turned out there was a backdoor connection and underhanded under the table shake taking place.
Yeah, I think that's a good segue to talk about, growth initiatives, growth versus anti-growth. So this is, I was mentioning that, certain cities have a lot of supply. Like for instance, Austin is permitting more new housing units than any other metro in the U.S. as a percentage of its housing stock. So I think in 2020, Austin is on pace to permit almost a 5% expansion in its housing supply, which is huge. That's massive. And then you have a place like Chicago or Detroit, which for maybe two reasons. One is there's not a lot of developers going in there, and then the other is they have these anti-growth initiatives. They're permitting like 0.5% to 1% expansion of their housing stock, and it begs an interesting question, right? While Austin's permitting a lot of new units, it's very pro-growth. So, while there's more supply, which might decrease value and rent growth a little bit, you probably feel better about the durability of your long-term demand increases, population growth, businesses moving in, et cetera, than you do in a place like Chicago, where the administration and the public policies aren't favoring growth, right? They're kind of trying to, if they're doing that with you or someone looking to own an apartment building, what are they doing with the corporation that wants to move into the city, right? Or the corporation that wants to expand? It's probably a similar situation. So it's an important thing for people to also consider when they're
are there any other cities you're seeing similar like that outside of Texas or other cities that you're seeing big growth on the permit stuff like that?
Yes, I am. So Austin is one. Nashville is another. Nashville is not quite on Austin's level, but it's like around 3.5% supply expansion, nearing 4%. And Nashville's got a lot of positive things going on, a lot of growth, a lot of Alliance Bernstein relocated there, and they're starting to get a little bit of a tech presence. But so Nashville's permitting a lot. Raleigh is permitting a lot. Now in Raleigh, it's very interesting though. Raleigh's permitting skews a lot more to single family. So Raleigh actually might be number one in single family permitting, but they're pretty low on multifamily permitting. So if someone was an investor in Raleigh, they'd probably want to understand that distinction. If you're going more for if you're buying a home or you're going more for a single family rental, you might have more supply competition than if you were to buy a more traditional multifamily property. So that's actually another interesting to think about. Are we permitting more multi or more single family? Most markets are kind of like even, like they kind of find that balance, but some markets kind of are skewed one way or the other, more towards single or more towards multi.
That's interesting. That's definitely an important thing if you're a local guy trying to get into investing and knowing where the opportunity lies, or if there is little opportunity where you're located, it makes a whole lot of difference. And I think it's one of the biggest things that I like the most about looking at so many different markets. There's a lot of opportunity across the country if you can get out of having to touch and see everything personally in a lot of cases, and be able to use vendors or realtors or other investors to be your eyes and ears in those different markets out there.
Sure, of course. And I think that's where data comes in, because there are so many different deals and opportunities in cities to explore, right? Often with my clients, the question is, how do I save myself time? It's first, how do I figure out the best places to be? But then it's also, how do I save myself time? If I'm entering a new market that I'm not as familiar with, let's just say I'm going into Raleigh-Durham. To make heads or tails of that market can take months of talking to brokers, months of visiting there. And data is not a replacement for doing that by any means, but if you can hone in on, let's just say, several key zip codes that meet your criteria, meet the criteria for growth, that really just focuses your efforts and saves a lot of time.
Yeah, data is such an important thing versus just flipping a coin. Oh, I feel good about this market, But that's the whole point. Is, I mean, some people get away from that, and and data, while it is, I think it's one of the most important, it's used as a filter to kind of help you filter through all the different opportunities out there, and then coming to the point of marketing specifically for deals in that neck of the woods or opportunities out there. With hang on one second here. So obviously data is important. Now you've got some proprietary stuff. I don't want you to give it away, but you've got some interesting stuff that you pull in. That how did you come across this? This goes back to your days as a commercial broker and or mortgage broker and stuff like that. But how did you kind of pull these different things in to help you identify that? And how did your company come about? Because that's a kind of a bit of a big jump from going to on the origination side to being such a valuable data and resource for people.
Of course, it's a great question. So I'll say, for me personally, it starts back with my education. I was an economics major. I went to the London School of Economics. So I've always been a nerd.
Nothing wrong with being a nerd, baby.
Always been a nerd.
Nerds rule.
And so I always had that inclination, even when I was working on the origination and underwriting side.
Yeah.
And as I worked more on the side of the business and I did more deals, the desire to understand these markets better really just took over. So when I founded Reventure about 18 months ago, it really was a deep dive for about a year into academic papers, talking to all these different people in different markets, learning coding, so I could actually pull the data that I needed when I wanted it. So a lot of the data is actually out there. I pull a lot of data from the U.S. Census,
mm-hmm.
and you can get really granular with census data. I can find out the percentage of people between 25 and 34 years old and their median household income by zip code and how it's changed over the last 10 years. Like you can get down to that level of granularity with the U.S. Census. They just make it very hard actually to extract the data.
Yeah.
You kind of need to know how to do API calls and coding and stuff like that. So that was something I learned to do over the last year, and basically amass this really big database of a lot of census data, also data from the Bureau of Labor Statistics.
Mm-hmm.
They have a lot of great information on employment and types of employment.
Yeah.
Right, because right now we saw how this downturn negatively impacted service-based jobs a lot.
Yep.
Right, and you look at year-over-year decline in employment. Las Vegas is leading the way. A 12% reduction of employment year over year. And well, could we have predicted that? Well, yes. If you look at the percentage of service jobs in their economy, right? And so maybe Vegas will have some issues over the next 12 months because of that. So really putting all that stuff together. Another data source that I like using is from a place called Crunchbase. They analyze venture capital and startups and IPOs. And why that's really important is, if you have a lot of startups and tech in your economy, that's been proven to create huge numbers of jobs, not only in that industry, but all across the economy. There's a Stanford economics professor, his name is Enrico Moretti, and he studied this in 2010, and basically found that for every one tech job added to an economy, that tech job adds another 5 jobs over the next 10 years in different service-based industries. So if you think about that, let's just say Google opens up a satellite office in Austin, which I think they now have several regional headquarters in Austin. But that Google tech worker probably makes a decent amount of money, probably makes like $150,000 or something. And well, now he's spending that money in the local economy, right? All of a sudden, restaurants, barbershops, yoga studios, fitness centers, all of a sudden they have more demand and need more employment. Not only that, Google will then need accountants and lawyers and things like that. Maybe Google has their own corporate, but a startup would certainly need local people, right? And so, yeah, one tech job creates 5 additional jobs across the economy over the next 10 years. So looking at that data from Crunchbase and analyzing it on a metro level and looking at which markets have the most startup venture capital rounds, which ones have the most IPOs, right? If a company IPOs, typically their employment will, I believe it's triple over the next 5 years, 5 to 10 years. So all of a sudden, if you have a lot of new IPOs in the economy, you're predicting future growth. And so that's one that I also like a lot and has a lot of research backing it up.
If you think about that, that makes a lot of sense. Obviously, with what's going on in Silicon Valley and San Francisco, with it being so dense, but also in other areas like Boise, which you think back about 10 years ago was really kind of brand new, and it's really blossomed into that. And then you look at like, was it Chattanooga? Tennessee's also had kind of a burst of high tech stuff and really kind of regentrified that market between Arkansas and
that's right.
You know, the neck of the woods in Tennessee. So interesting. That's an interesting. I like that. It's got my head spinning. You know, in a lot of cases.
It's great because again, I can't tell you how much it bugged me every time a broker or the sponsor was like, "Oh, this is the tech hub." I was like, "Is it really?" But looking at this data allows you to answer that question conclusively, right? Which is what I like. And yeah, you brought up Chattanooga. Chattanooga is a great market. I was briefly there about 9 months ago, and I was shocked at how much nice new multi-supply there was, how vibrant their downtown area was. So you know, if you can spot, you know, if you can use data to find, you know, a diamond in the rough, so to speak, that, you know, might not have gotten a lot of attention. Chattanooga didn't get a lot of attention 5 years ago. Now it is. You know, that's also a great way to find return and value.
Let me ask you a question. We're talking about growth, expansion, high tech jobs. Let's flip the script a little bit here in affordable housing or really low end housing, because that's really when you have something like that, when the price skyrockets, it's that, I hate to say it, but it's that low level poverty line that really gets squeezed out in a lot of cases. And there's an opportunity for that, for people, you know, creating tiny houses or using 3D, even seen some 3D printing taking place, or modular housing in a small communities. Any opportunity? Do you see they have anybody approach you looking for places in the country to maybe have that stuff spring up by any chance?
Yeah, you know, I haven't had someone approach me on something that specific like modular housing, but I do have a lot of clients who really specialize in that affordable space, right? It's not Section 8, right? It's not like that, but they're really focused on providing quality housing for people that need it. And it just so turns out that demand segment and that type of supply has performed best of any residential supply segment in the last year. It's really been that Class C, more affordable housing segment, which has done the best over the last year. Actually, Class A has kind of trailed, believe it or not. And so, yeah, there's certainly markets where you can prioritize for that. You know, you said Boise. Like, I like Boise, but Boise went from affordable to trending to unaffordable pretty quickly.
Yeah.
So, you know, a place like that, I would be, you know, maybe 4 years ago or 3 years ago was that affordable entry point, but prices in Boise are starting to get above what you would expect given incomes in Boise. And that's really the metric to look at. What does that average annual rent look like to average annual income? And what does that average home price look like to average annual income? And if you can kind of find markets where, you know, there's more affordability, I think that's better for long-term demand. You know, if that makes any sense.
Totally makes sense. It totally makes a lot of sense there, because those are very key figures to look at to identify. Otherwise, it's too expensive, and you're outpricing your supply of borrowers or renters or property owners in a lot of cases.
That's right.
I'd be interested, because you mentioned that 25 to 34-year-old category there.
Yeah.
And you target that market. Why? Because it's a lot of the first-time home buyers, or people are going through the most amount of change in their income levels. Why'd you bring that up?
That's a great question. So there's a couple of reasons why you target that demographic. I call it the millennial percentage.
Yeah.
And Yeah, so that market, like you said, well, first of all, it's the highest rental market. So if you look at rental versus owner share, right, and by age, owner share will go down the older the age demographic gets. So if you're in a place with a heavy 25 to 34 population, you know that there's a lot of rental demand in that population. And then there's also that transitional demand that you mentioned. So those are people who might be moving into a city. Also, they might go to that area, so they'd be more inclined to need rental housing. In general, that demographic is less settled in their life, which is good for renting, right? You want people who aren't settled, right? You want people who aren't ready to make a commitment to owning necessarily. The other thing about 25 to 34 is that tends to be the leading indicator of, let's just say, the growth or hipness or coolness of a neighborhood. So if you start seeing an increase in 25 to 34 population, chances are you're also going to start to see quality retail. And then that becomes a self-reinforcing mechanism. So once, quality retail starts going in reaction to more 25 to 34-year-olds being there, well, that makes the area even more desirable. More people want to move in. So yeah, 25 to 34, and sometimes even 25 to 44 is that really key age demographic in terms of both local and at a metro level. So this is taking it kind of a step up for a second. But if you have a metro or a market with a high 25 to 44-year-old population, that would be Austin, by the way. Austin has the highest share of 25 to 44-year-olds in their population of any city in the US. That's good for growth everywhere in the city over the long run, because a younger population means more employers are moving in because of the labor force. A key factor people often don't think of too, that means more births. If you have more 25 to 44-year-olds, that means more births in the population. More births equates to more consumer spending, which equates to more jobs, which equates to more demand for housing. So, it's important to look at that age demographic both locally and zooming out at the market level.
I love it. Yeah, it makes a lot of sense. And that's some great contributing factors to a lot of things. Yeah, you put a lot of young people, there's going to be third people that show up there really fast. You know what happens with that. What causes that? But also increasing hospitals and daycare and other things that go along with it. The tertiary markets around the side there for you. Now, I just had a question that popped in my mind here. You studied at in London.
Yeah. London School of Economics, yeah.
London School of Economics, man. Yeah, you were there for a semester or a year? How long were you there for?
I was there for a year.
Gotta have been a fun time. And London, I get a lot of people that come over here and they're like, why can't we start doing what we do with the mortgage industry over there? And London's such a unique city, but a very expensive city in a lot of cases, right?
Very expensive. Very, very expensive.
If you were to compare London to a city here in the United States, as far as expensive wise or market similarities, what would you compare it to?
Yeah, I mean, there's really only three potential comparisons. Would be New York, Boston, and San Francisco.
I thought you'd say that.
There's no other city in the U.S. that compares to London in terms of cost, but then also like size. I'm trying to remember. I had a sweetheart deal as a student. I lived in Trafalgar Square in a resident hall for something like £1,000 a month, which was, I think the market rate though for that apartment was maybe £3,000 a month, which would be like $44,000 or $4,500. So yeah, London's a special city. It's my favorite city, but you need money. You need money to live there for sure.
Yeah, it's definitely one of those cities. I've spent some time there traveling in the last few years. It is one of our favorite cities, and we've always toyed with the idea of bouncing around and living abroad for 6 months in different places, and London being one of those things. Are you seeing anything that you're looking at with foreign investors coming into the United States? Are you ever any outside organizations or investors that are looking and coming to you?
There's a lot of foreign investors.
Where do you see them coming from in different parts of the world?
Right now, Middle East.
Okay.
I'm seeing investors from the Middle East who I'm talking to with their plans of expanding and investing more in the U.S. So that's the biggest segment. I think the investment foreign capital from China might have tailed off a little bit with some of the capital controls that the Chinese put in, but I'm seeing Middle East, I'm seeing Singapore, places like that. So it's always, that's great to see, to be honest, because the more foreign capital and the more people we can, get and who are interested in investing in U.S. real estate is good for U.S. real estate. So that's a positive sign. And I think we'll see even more of it in 2021, as hopefully the COVID situation improves and travel opens back up a little bit, right? I think that'll even kick into a higher gear.
Yeah, I think we've seen it quite a bit. It's interesting. It's going to be an interesting year. But the point is, if you know how to pivot, know how to read the trends, read the numbers, you've got to definitely a lot of opportunity. And I love with what you're doing, because you're really seeing through all the emotion. You're seeing straight down to the numbers and the trends. And a lot of people, we've had the markets keep going up for such a long time. It's bound, and as I've been saying, I think in a lot of places it's overpriced. I think Austin being one of those markets here, and other places, it's got to start either flattening out or dropping down in areas there. I mean, it all averages out, but knowing those areas where it can drop down, where you get some opportunity to ride it back up in the next kick makes a lot of sense, I think, don't you?
100%, without a doubt. And I think that's why, like I said earlier, right now, for me, there is a lot of insecurity in the economy and socially and what's going on with COVID, right? So when there's insecurity, it's time to really focus on fundamentals. Like you said, let's stop talking. Let's stop, going with platitudes and going with gut feelings. Let's really focus on the fundamentals, because that's what's going to matter in the intermediate to long term. And yeah, I think you're right. There's a bunch of markets which are a little overpriced right now. Austin might be one of them. Although I don't necessarily think every neighborhood in Austin is overpriced. I think certain neighborhoods are.
Correct.
Targeting that market like in Columbus, Ohio, where your entry point is still really solid. You're not spending too much money. So there isn't much room for values to go down. And then there isn't much supply getting built. And you couple that with strong increase in households and population. You're really basically hedging your bets there. It would take a lot to go wrong, right? If you were to invest in a market like that. Whereas, you invest in a market with a lot of supply and increasing values, well, your margin for error just shrinks a little bit. And you need to really make sure you get into the right location in that market. So, that's the way I view it. I would never say totally ignore this market,
right?
Or totally just go into this market, but know the risk factors going in. Do I have more of a runway for error, maybe in a place like Columbus or Indy? Do I have less of a runway for error in a place like Austin? And how do I then approach my decision on where to buy because of that?
It makes a lot of sense. I mean, it's so truthful. We've had Austin investors who were targeting San Antonio or other Corpus Christi, even because they didn't like the pricing in Austin in a variety of different ways, or they found what they were looking for in other markets that made more sense to them.
Yeah. When in your mind, when was, say, the turning point for Austin?
Oh man, I think I honestly say it was about 5 years ago, because it changed. And a good example is looking at downtown Austin on the east side of I-35.
That's right.
When it used to be shacks and you'd have people going there and ripping those down and building up a beautiful house. Now, I mean, a lot in East Austin, you could pick up for 10 grand or less. Now it's 100 grand. And looking at that aspect of things. Now, obviously, we've had some issues where you had houses that were built up too much that they had the underlying utilities couldn't handle, the water and the sewage and stuff like that, overdeveloped. And that. But I honestly think it's about 5 years ago as we started seeing a trend of more people here locally, as I was out networking, talking with people, and they're investing in other markets because just the lack of inventory of deal flow. It's not mean that homes were being bought up, but for stuff that made sense for them as a real estate investor to pick up something at a discounted price, that they didn't have to go in and try to, okay, I'm going to buy a shack and do this total rehab job to try to uplift the value by turning it from a 900 square foot house to an 1,800 square foot house. You know what I mean?
That's right. Is that, and was it 5 years ago that you mentioned that some of the local investors were like, this is getting a little too hot, I'm going to go to some other markets? But was that also, were there more external institutional investors? Was it around that point when they started coming in?
I would say it would be more so not institutional. I would think it'd be more of the influx of people from the West Coast, California, Arizona, because that's really been a big thing with people moving here to Austin, where they could sell their shack. I say shack, comparatively compared, but they could move out here, buy 3 times the size of a house for a third of the cost of what it would be in San Diego or LA or Orange County. And so with Texas and Austin being one of the number one, I think, transitioning markets for people from the West Coast, moving has been a desirable city. And you just have to look at like the west part out. Steiner Ranch has been part of that, for the last 5 to 10 years. And then looking out at 4 Points out where 620 and 71 meet. All that was basically nothing 10 years ago, except woods. Now you've got the biggest, technically, the mall on the neck of the woods, and all its high-end housing and high-end shops, exactly like you just said, has filled in, and that's where they expect this, the town center, or the physical looking center of Austin to be here in the next couple of years. So it's interesting.
For the traffic, hopefully that becomes true.
Right
now the center of the city. Oh man, it's and I haven't even experienced the most brutal of the traffic because I moved here during COVID, but I heard nightmare stories about going on 35.
Well, that's the thing is I avoid 35 like the plague. That's why I live north. I go downtown off hours if I can. That was when we started this episode, we're talking about how each city can rank the best for one thing.
Yeah.
And Austin for years has been the number one city for the worst traffic problems in a mid-sized market for the most part.
Right.
So
yeah.
And if they do decide to do some, big development downtown, turning like 35 there at the river, at Riverside into like a tunnel and other things like that they've toyed around. I think part of the issues too has been the city council and the leadership has been very anti growth, up till about a few years ago. Now they've kind of changed up and realized they have to embrace it. And that's part of the issue with the traffic here is they didn't do a good job of planning out roads and highways. And then you look at what San Antonio has done with the inner and outer loop. They've been much more progressive into planning the growth and expansion and the infill taking place. So it's not, San Antonio's traffic, but it's not nearly like what Austin has for the most part. You could lose 52, 55 hours of your life sitting in traffic on an annual basis.
Yeah. I think with the COVID situation, working from home, I feel like a lot of people, and maybe some people who had the fortune of being able to make this decision, said, I'm over that. I'm going to do that anymore. I'm going to put myself through that. So, I think like what we talked about, hopefully, and I think that will lend itself to more of this polycentric model where you don't need to be as focused on that urban core of the city. You can be 10 miles on the periphery this way, 10 miles on the periphery that way. And you're really starting to see that trend in a lot of South and Southeast cities. So I hope we see that more. Like you said, Steiner Ranch, we have the Domain. I hope we see that more in a place like Austin as well as other cities in the South.
I hope so. Nick, this has been fun. What is the best way for people to reach out to you, to connect with you, to find out more about what you're doing and work with you to help them make accurate decisions on their investment?
Of course,
decisions?
Yeah. So the best way is to reach me or going to my website, www.reventureconsulting.com. And then would also be subscribing to the YouTube channel, Reventure Consulting. I post videos 2 to 3 times a week there. So that's a really good way. If you want to just learn more about the data that Reventure Consulting has and how it can help you, go to the Reventure Consulting YouTube channel, subscribe, and keep up to date with the videos. That'll help inform you and then give you a better idea of what Reventure does.
I love it. We're going to put both of those links in the video links in the video description and also the blog for everybody to go out there. Do it. Highly recommend it, guys. You can get sucked into a lot of the great stuff that he is doing, and it is so valuable and really the best opportunities. And those investors that are going to succeed the most in the next 12, 24, and 36 months are the ones that most informed, that understand the numbers and the trends. You can't just throw a dart blindfolded. You got to really look at what you're doing. And that's part of the reason I want to have Nicholas on here, because I saw what he's doing and it can add value to all of you out there looking for. So Nicholas, thank you so much for coming on the Note Closure Show, man. This has been great. We have to continue the conversation. I'm going to have to come back in at another time a little bit.
We definitely will, Scott. Thank you so much for having me on. This was a pleasure. It was really good talking to you and talking to your listeners. So
yeah. Where's your favorite place for brisket in Austin so far?
All right. So Bob's probably. It's a food truck in South Lamar. It's been the best I've had. I still got to go to Franklin's though.
Yeah, that's a bit of a wait. But it's good. What about tacos? I know you've been inundated with breakfast tacos, at least of some sort. Favorite place for tacos?
Yeah, Lazarus in East Austin.
Oh, that's good.
Brewery coffee shop, but they have probably the best breakfast taco I've had. And then I know it's a chain, but I really like Torchy's.
Torchy's, come on, babe. Austin original. You gotta love the little devil.
I wasn't sure if it was less cool because of the chain or not, but I really like Torchy's. The Lazarus and Torchy's.
Yeah, you can't go wrong there. That's awesome, man. We'll have to get together for breakfast and some brisket at some point. All right, brother?
Let's do it.
Thanks, Nicholas. We'll see you later. Guys and gals, go out, take some action. Go subscribe to Nicholas' YouTube channel. Well worth it, like I said. If you're looking for opportunities, are burnt out in your local market, can't seem to find anything, it's probably because the market has moved on from your investing strategy and what you're looking for. So take Nicholas' advice, check out Reventure, and identify different markets. It's the 21st century, ladies and gentlemen. You don't have to live in that market to invest in that market, like I've been doing for the last 10 years. So go out, take some action, buddy, and we'll see you all at the top.